If you ever tried to study trading and felt like the market was a giant puzzle that never quite fits together, you are not alone. That's exactly what Michael J. Huddleston, better known as the Inner Circle Trader or simple ICT, set up to change. ICT's concepts have become a cornerstone of modern price action trading. His techniques explain why price moves the way it does, where big players enter, and how you can align your trades with institutional flow instead of fighting it. At its core, ICT is not an indicator-based system. It's a framework, a way of reading the market through logic, liquidity, and structure. It's about understanding the mechanics behind every move. Michael teaches that the market isn't random, it's designed. Every price move serves a purpose: to find liquidity, to fill orders, or to rebalance inefficiency. He often says, the market is a business model. ICT focuses on studying how smart money operates, the banks, algorithms, and institutional traders who accumulate, manipulate, and distribute positions. Instead of trying to predict with emotion, ICT traders observe structure and wait for the market to reveal its intentions. Let's go step by step through the core ideas that form the ICT framework. The first one is the market structure. Everything starts with market structure. ICT defines structure through breaks of market structure, BMS, and changes of character. When price breaks a previous high or low, that's your first clue about direction. When it fails to continue and reverses, that's a structural shift. ICT traders read structure to align with the narrative, what the market is trying to tell them through price swings. The liquidity. Liquidity is the heartbeat of ICT theory. The market always moves from one liquidity pool to another. Above equal highs, there's buy-side liquidity, clusters of stop losses waiting to be triggered. Below equal lows, there's sell-side liquidity. ICT teaches that price hunts these zones because institutions need those orders to fill their own. So instead of chasing price, ICT traders wait for liquidity to be taken and then they enter in the opposite direction, aligned with the true move. This is what he calls a liquidity sweep. The third one, imbalance and the fair value gaps. When institutions execute large orders, price often moves fast, leaving untraded areas on the chart. ICT calls these the fair value gaps, where price skips too quickly and didn't create balance between buyer and sellers. These gaps tend to attract price later. Why? Because the market seeks balance. It wants to fill those inefficiencies before continuing. ICT traders look for price to return to these fair value gaps to find low-risk entries in the direction of the main trend. The number 4 is the order blocks. An order block in ICT is the final opposite candle before a major move. It represents the last place where institutions accumulated orders before driving price away. Order blocks serve as institutional footprints. They tell you where smart money entered and where they will likely defend their positions. Combined with the fair value gaps, they form high probability setups when price returns to rebalance those zones. The number 5 is premium and discount ICT, divides every price swing into two halves. Premium and discount. Using the 50% midpoint, if price is below the midpoint, it is discount, an area where smart money looks to buy. If price is above, it is in premium, where they prefer to sell. The rule is simple. Buy low, sell high, but no emotionally. ICT gives a technical framework to define exactly what low and high mean. The number 6 is time and liquidity, the kill zones. One of the ICT's most unique concepts is kill zones, specific times of the day when institutional activity is highest. There are 3 main kill zones. London, open 2 to 5 a.m. New York time, major liquidity grab as European markets open. New York, which open 7 to 10 a.m., strong volatility and continuation moves. New York PM session, 1 to 3 p.m., often reversals or retracements. By focusing only on these active windows, traders avoid the choppy, low-volume hours and align themselves with the true institutional flows. The number 7 is the optimal trade entry. ITC's optimal trade entry combines multiple elements: a clear trend and structure, a liquidity sweep, a retracement into the 61.8 to the 79% Fibonacci zone, a confluence with a fair value gap or order block. This setup filters out noise and helps traders time precise entry with minimal risk and maximum reward. The number 8 is the market maker model. One of the ICT signature teaching is the market maker model, a visual framework of how smart money accumulates, manipulates, and expands price. It consists of 3 key phases: accumulation, conciliation, smart money builds positions quietly; manipulation, liquidity grab, price fakes out in one direction to trap traders; and the third one, distribution, expansion, the real move begins. This model repeats across all time frames, minute charts, daily charts, even weekly charts. Once you start recognizing it, the market suddenly looks a lot less random. Let's go through an example step by step. Imagine EUR/USD has been trending upward. You notice equal lows forming below liquidity. During the London session, price dips down, sweeps those lows, and instantly reverses. You identify a fair value gap forming on the move back up and a bullish order block just below it. Price retraces into the fair value gap around the 61.8% retracement level, your OTE entry zone. You enter long there, place your stop just below the liquidity sweep, and target the previous high. That's a full ICT-based trade, from liquidity grab to the fair value gap entry aligned with institutional structure and timing. The ICT's methods can seem complex at first, but once you internalize them, you start reading the market like a map instead of guessing in the dark. It gives you context: why the move happened, where it began, and where it's likely to head next. Let's recap the essentials. ICT is a complete framework, not an indicator. It's built on structure, liquidity, and institutional logic. Key tools: market structure, liquidity, fair value gaps, order blocks, premium, discount zones, kill zones, and the market maker model. It focuses on patience, precision, and reading price with purpose. In simple words, ICT teaches you to think like institution, not as retail trader reacting to candles, but as a smart money creating them. So remember, trading isn't about predicting, it's about understanding. And once you see the market through the lens of the ICT, you will never look at price the same way ever again.